welcome to India is the Worst Over, a global view with me, Tanveer Gill. Joining me today on this Diwali Special are three prominent global experts who will analyze the India story and give us their outlook for India over the next 12 months. That is for the new Samvat. My guests today on the show are Marsha Gordon, Head of Emerging Market Equities at PIMCO, Adrian Lim, Senior Investment Manager at Aberdeen Asset Management, and Art Wu, Director Sovereign Ratings at Fitch Ratings. Thanks very much to all three of you for joining us on this special edition. Marsha, let me begin with you. India has been one of the weakest markets this year so far in terms of dollar returns. Does that underperformance, clubbed with a weaker currency and some stability in the macro environment, make a compelling case to buy India right now?
Well, I think what makes a compelling case to start looking at India is the stability that reemerged post the appointment of the new RBI governor. He has brought forward quite forcefully an emphasis on anchoring inflationary expectations. He's gone against the grain and has increased repo rate, not once, but twice. And I think that type of monetary stability, even though it means temporarily higher rates, brings forward the framework of stability that could prompt investors start looking at compelling value.
Right, but Marsha, what are your return expectations from India in view of the slowdown and inflation risk plus a weaker currency?
Well, look, I think the midterm will be not very easy. And the reason for that is in order for us to see India really going up to see the former greatness, we need to see the investment cycle restarting. Now, we are clearly in a period of pre-election dynamics. That means that fiscal side is not going to be help for businesses to see lower real rates, right? We will see, again, spending directed towards consumer, which inevitably means high inflationary pressure. And again, in the next 6 months, businesses will be very much in the wait-and-see mode to see whether the new fiscal regime that might come after the election will result in tax incentives, less red tape, and lower taxes. So I think we need to see very much the backdrop of more benign policy environment to start thinking about the returns of former glory. So by that I mean 20% plus from the market. What is implied by the market and market valuation is some 12% nominal earnings growth. Now, in the past few years, that has proven to be too optimistic. We have the benefit of lower base effect, so in the coming year we may see earnings growth in the order of 10 to 12%. Given where the market is rated, it's not particularly rich relative to history, but neither it is cheap relative to other EM markets. So if we were to see the prospect of better growth materializing in the high year, you could see some mild re-rating. So that coupled with earnings growth could give you a 15% return.
Fair enough. Adrian, come to you. For countries like India, would it be more domestic factors or global factors which will drive your outlook from here? You know, what will really determine the course of the market? Do you think that the worst is over for India?
Well, this year has been a mix of both, and I think it's always an interplay of both issues. When you do get a steady, calm global investment climate, then the global investors tend to focus on country-specific issues. But when you have the seismic moves in policy, in the tone of quantitative easing or tapering, you will always get these global issues overwhelming the local market issues. I think for India's case, given the severity of some of the local challenges and how much that's been played up in the media, both the local and foreign news will continue to play a big part in the tone that investors have towards the country.
Art, come to you. From your March 2013 view, when you said that India could more than likely get downgraded to revising the outlook to stable from negative around summer, do you think that the worst is over for India?
Currently, we have India's ratings on a stable outlook, which we revised back in June. And we think this really fairly reflects the outlook for India's sovereign ratings. We understand that India's economy is going through a difficult transition period, given recent pressures on the currency, which has spilled over onto the economy and onto inflation. But at the same time, we do recognize that there has been some developments in terms of improvement in the current account, and there seems to be a change in the RBI's focus on inflation, which is a positive development.
Art, do you expect India to finance its CAD given the forest reserves that the country has? CAD will more or less come in at 4%. That's the broad expectation. Fiscal deficit will be kept at 4.8%. What are the assumptions that you're working with on how these numbers could change post-election for FY15? Targets have been laid out there, but what is your own assessment?
Well, I think we expect the CAD to improve in the coming years. So last year, the current account deficit came in at about 4.8% of GDP. And recent trends show that there's been a large correction in the trade balance, which should flow over into the current account deficit. So right now, our baseline expectations for the current account deficit to maybe come in around 4% of GDP, and even perhaps fall further to around 3.5% to the 3% range in the next coming 2 years afterwards.
Marsha, when do you assess possible tapering and the timeline for that? What is your expectation and how it will impact emerging markets?
Well, I think the notion of normalization of rates is out there. We, as a House, have a view that that may take longer than market is anticipating. Now, there are certain milestones in Fed communication of Fed policy, such as press conferences, such as changeover of the helm of the chairmanship. So we think that tapering is unlikely to happen before March. Now, a lot depends, clearly on the performance of the U.S. economy. Should we see weaker numbers coming through or more lackluster consumer confidence, that may be delayed further. But again, we would expect some normalization coming through in the first half of next year.
Fair enough. Adrian, coming to you, do you expect investors to be positive on emerging markets despite internal issues that they seem to be struggling with? Will fund flows likely to be strong over the next couple of months?
Well, I think globally, almost every region, almost every basket of investment asset class struggles with something or the other. I think the challenges in emerging markets are not new. High levels of inflation, currency volatility, some fiscal indiscipline, these are not new issues. And I think that given the strength in foreign reserves as well as the demographic advantage of some of these countries, the emerging markets are better placed to recover from these challenges than their counterparts in developed markets. So I am positive on most emerging market cases.
Art, come to you. What is your view on the currency for 2014 and also your view on rates? Will we see more hikes from here?
Yeah, assessing both the foreign exchange and interest rate outlook is quite difficult given recent events that have taken place over the summer where there's been a lot of pressure on EM or emerging market currencies because of concerns over Fed tapering. And given that Fed tapering has yet to happen and is likely will happen inevitably or eventually, that just makes the outlook for both the FX and interest rates difficult to assess in India. But I think, the rupee is likely to remain range bound at the current range, current levels, and similarly, interest rates also. The RBI has indicated that they're going to be more focused on headline retail inflation going forward, which means that the policy rate, which the RBI actually increased in its last monetary decision, may actually increase a little further.
Master, come to you. Do you expect the hawkish stance from the RBI, with their focus on inflation to continue?
We actually laud, the resolve of the RBI to establish rates that are favorable for savers. You have a situation in India, or you had a situation in the past year when savers were disincentivized to put money in the banks and were incentivized to buy everything else, such as gold. I know it's a cultural trait, but that those gold purchases tilted current account into a greater deficit. So clearly, firm focus on inflation and inflationary outlook, and independence that, clearly the new governor has projected are very, very positive steps. So I think that we would take the near-term hawkish rate outlook as a positive because it brings long-term gain.
The other key variable, and coming to you on that, is growth. On growth from 6% plus, they're having several downgrades this year. How do you see the growth cycle panning out? I mean, IMF is now projecting 3.7%. The World Bank is projecting 4.7%. Fitch itself has revised its number to 4.8%. Do you think 4.5% could be the fair range for this year?
Yeah, it's difficult to say. We're currently forecasting 4.8% of GDP versus 4.8% for GDP growth this year versus 5% next year. So I think the way to interpret the GDP data is that it's suggesting that the economy remains quite weak, and looking ahead into fiscal year 14-15, that the economy's recovery is likely to be quite weak, where we're expecting growth to still be in the 5.5% to 6% range. So overall, the prospects for a sharp economic recovery still remain quite low.
Masha, when do you expect revival in growth in India? Are the days of 8% gone?
I think 8% growth with current India's infrastructure is perhaps a misnomer. We need to think about growth and growth dynamics in terms of trend non-inflationary growth, and 8% clearly with current infrastructure in place is a tad too high. Had India invested in its supply side and made reforms over the past 5-10 years, this may have been a reality. But again, today, currently, with the level of infrastructure we have with macro imbalances, 8% is a high number. Now, where do we stabilize? If RBI is successful in anchoring inflation, and if the election outcome results in a more dynamic government that helps on a fiscal side to lower real rates, and that's the core problem of India, high real rates for businesses, too high, arguably, to do much, and too low for savers to save, given the inflationary story. So if we were to see that stabilization, the more hopeful election outcome, I think we could see growth in the range of 5 to 6%.
Adrian, same question to you. What kind of growth do you expect from India in FY14 and FY15? As a fund manager, 4 to 5% growth, do you think is reasonable to not change your outlook on the region?
I wouldn't invest in that market because it's written off on broad capital market or US dollar measures over a 9-month period. And we don't do things that way in Aberdeen. We pick stock. We get the best quality stock and we try and buy it at a reasonable price.
Master, let's talk about specific themes that interest you in India. Which are the sectors that you're broadly overweight or underweight on, respectively, in India at the moment?
Our exposures today are limited to the position in Tata Motors and select positions in private banks. We stuck with those positions. They clearly have been a difficult, place year to date, but we've added to a number of private banks when the level of pessimism reached, and more importantly, the level of valuations reached an area of absolute pessimism. And again, we do think that a number of those franchises are looking quite attractive. So today, these are the areas that we find compelling. clearly we have a very firm eye on the value starting to emerge in consumer staples area. Now, that has been an area that has experienced a substantial re-rating and where we're now seeing earnings downgrades. So should we see significant pullbacks in these consistent earners and long-term growers will clearly look to initiate positions in those names. It's still too early. We need to see a far more compelling value emerging, but these are the companies you can own long-term, and this purchasing those amidst earnings disappointments, again, long-term proves to be a winning strategy.
It didn't come to you on your investment ideas in India. You have cut your stake in TCS recently. Are valuations starting to look stretched there? What is your view on earnings from the other IT majors like Infosys, HCL Tech? They all seem to have surprised on the profitability front at least.
I think the capital markets overplays the volatility or the perceived volatility in IT stocks. All of the companies in the IT space, at least among the majors, have been very profitable. There have been some margin pressures, but largely they have been very resilient, very profitable with strong balance sheets. And these companies compete in a very competitive landscape with global peers for global customer wallets as well. And we think the quality of this sector is very high. TCS, we've taken some profit, but these are relatively small portions of cutting back. If you look at our positions at the end of the month, you'll see that our funds would still have quite a very substantial chunk in TCS, and TCS remains a core holding for us. I wouldn't read too much. I think there's a danger of reading too much into us taking some profit from TCS.
Masha, how are you looking at financials then in India? There have been some ratings downgrades also on banks due to asset quality concerns. Will the situation get worse if rates continue to move up?
We are steering clear from state-owned banks. We do think that the normalization of credit quality may be a longer road than some hope, and therefore, again, we would stick with higher quality private sector banks. And we add to positions when the value becomes very compelling. So if you were to look at companies like Yes Bank, they did derate to close to 1.2 times price to book. This is a long-term growth franchise, and this is the company that long-term will be a compelling M&A target. So clearly, when you deep into distressed value, you need to make a call whether capital raising is required. Again, we made a judgment call that it was not imminent, and at that point, that represented an interesting risk-reward opportunity. Currently, obviously, the banks have swung back in value. Perhaps today that risk-reward is not as appealing, but again, within banks, we have strong preference for private sector banks, even though they often trade at the multiple that is 2 times higher than the state-owned banks.
Adrian, the consumer story in India is much talked about. Do they still offer favorable risk-reward given where valuations are? What are your views on ITC, HUL, Godrej Consumer, and even Nestle perhaps?
Well, we hold all of those stocks. We like the positions within the Indian market. They do currently service the medium tier and upper tier of households and families in India at this point in time. The attraction for us is that over the next 5, 10, 15 years, their market penetration will go deeper as India gets richer and has more spending power. And we are convinced that they are run by strong management teams. Risk-reward is very difficult to call. A lot of the share prices have been steady and resilient, and that's a call that I'm sure your viewers will have very strong views about one way or the other.
What about the auto sector? It continues to suffer from slow demand. Do you continue to prefer two-wheelers over four-wheelers at this point in time? What's your view on Hero MotoCorp?
I think the two-wheelers have got more traction. I think four-wheelers have got a lot of competition, but it's coming off a low base, so the growth trajectory can be stronger over the short, medium term. Having said that, it's a very competitive landscape, not just in four-wheelers but two-wheelers as well. We are big investors in Hero Motorcorp, and I think they've done a very cautious, steady job, a very savvy job of managing their transition from being partners with Honda to being independent. And it takes time to build a product portfolio, it takes time to build an independent brand, and it takes money and resource as well. And from what we've seen since the separation, the company has been very cautious about putting money to work, has been very careful, and that's not a bad thing. We feel that they've in effect focused on the right things.
Marsha, come to you. What are your top long-term conviction holdings in India stock-wise across mid-caps and large caps?
Again, given current environment and the uncertainty surrounding the long-term fiscal policy outlook, again, we're not out of the woods. If we have the current status quo persistent for the next election cycle, that would be very detrimental to long-term growth outlook for India. So given that uncertainty, and again, we are not engaging in election in election betting, we bet on franchises like Tata Motors that have a credible story of expanding Jaguar franchise to a different scale, and that have success to claim clearly in its Land Rover business. So, Tata would be our top pick. It's very inexpensively trading if you were to compare it even within the Indian space. It's not an India story, but it would have a nice kicker should the cyclical demand come back, given its position in commercial vehicles. And again, trading at 8 times 12 months forward earnings is inexpensive for a franchise that is going places.
All right, then. Thanks very much, Marsha, Adrian, and Art for joining us and giving us your views on this special Diwali edition. With that, we come to the end of this show. Here's wishing all our viewers a very happy Diwali. Take care and stay safe.